A lot of investors always look at this. Now, what will be the mistakes that a lot of people make? Let's take a look at these questions that I'm about to ask you. Would you rather get whenever you invest in something, you always want a higher rate of return or lower rate of return? So 15.5% return or 11.35% return. Which one will be your preference? The 15% return or the 11% return? Hello, I am Jason Stronghead. Welcome to my next video on investment education. I call it the Stay Foolish, Go Hungry for the investors. Now, why do I want to say that? Because, right, a lot of people want to make money. If you want to make money, there are certain things that you should know in order to help you position yourself better so that you will increase the chances that you will make more money. And if you think that, oh, I want to make money and just want to go ahead without any knowledge, without educating myself, the chances are you will get burned. So therefore, if you go foolish, what will happen? You will only go hungry because you lose more money rather than make more money. Okay? So hi, in this episode, I'm going to talk about the mistakes that some investors will tend to make during a stock market crash. Okay, so what is it? It's not just stock market crash. Actually, it's overall. A lot of investors always look at this. Okay, now what will be the mistakes that a lot of people make? Let's take a look at these questions that I'm about to ask you. Would you rather get whenever you invest in something, you always want a higher rate of return or lower rate of return? So 15.5% return or 11.35% return. Which one will be your preference? The 15% return or the 11% return? Yeah, so comment below, right, in the box. Which one you prefer? Is it the 15% or is it the 11%? Okay, my guess will be most people would choose 15%. Why? Because it's higher, and I would have chosen that as well. However, let me share with you something. In the last 10 years of my experience, right, in investing, and I've been always looking for big return. This is something that I realized. Let me show you a table, okay? So for example, there are two funds and you invested and you started off with just $10,000. Okay, so overall, this fund, the average return is 11%. But overall, this fund, the return is 15.15%. So which one is better, Fund A or Fund B? In terms of the average return, Fund B is better at 15%. Fund A gives you a lower rate of return at 11%. However, I want you to look at the total amount, right, that you have accumulated. If you start off 10%, average return 11%, you get about $27,681. And Fund B, your average return is 15%. However, take a look at your final value. It's only $24,372. So which one gives you more capital return in the end? It was Fund A. Okay, it is not a trick question, yeah, because it is unlikely that you can have very consistent return year on year. So which one would give you a better rate of return? The better rate of return will always be something that allows you to have consistent return and minimize losses. Okay, minimize big loss. So as long as you're looking at consistency versus higher return, right? Consistency actually will give you an edge over higher return. Now, what do I mean by that, right? Okay, so if you look at Avenger, a lot of people know Avenger. I don't know whether is it the best example. I've been cracking what will be the example that I can use in order to communicate this message, right? Okay, so if you look at Avenger, Iron Man is not the highest paid actor, you know. If you look at it, Thor is even paid more, right? Chris Hemsworth. Okay, Robert Downey Jr. is just 66 million, and that is the highest fee that he gotten, right? Okay, being paid as an actor, and Chris Hemsworth 76.4 million. So overall, Chris get paid more. So the return is higher for Chris. However, do you know who is the richest actor inside all the Avengers? Okay, Iron Man is the richest. Actually, this number is not the most updated one. The latest one, right after the end game, it's crossed 300 million already. And look at Chris Hemsworth, only about 70 million or slightly lower, slightly below 100 million. Yeah. So overall, do not look at just the rate of return. Look at consistency as well. The consistency is more important than the rate of return. If you're able to get very big rate of return but not consistent, overall, you will still not be able to make so much money. Okay, and the other point is this. when 4% doesn't equal 4%. Now, what do I mean by that? Yeah. So a lot of people always want higher return. But what if you are able to find stocks that will give you lower risk? That means, right, lower the risk that you will lose. Yeah. So instead of finding things that will let you make 4% more, why don't you find things that will allow you to lose 4% less? So if you look at this equation, overall, would it benefit you better in the long run? Let's take a look. Yeah, Fund A, Fund B, and Fund C. So let's take a look at Fund A. You start off with $10,000, and the first 5 years, you lose 10%. The next 5 years, you gain 10%. And overall, you'll be worse off, you know. So you minus 10 plus 10. So you thought you will not be able to, you will not lose much, right? Okay, but overall, actually you can see, okay, you only have a total equity value of $9,500. If you start off with 10,000, you kind of lost $500. Fund B, you will be able to find a fund or a stocks that allows you to make about 4% more. So let's say over here, the first 5 years, you lose 10%, yeah, 10%, 10%, 10%. But subsequently, when you make 4% more. So let's say you make about 14%, 40%. So by the end of the 10 year, you will make about 2% on average, and your total value will be 11,364. Yeah, so you will be better off, right, 10 years later by about $1,300. But what if you found a stock or an instrument that allow you to lose less? So let's say when people are losing 10%, you only lose 6%. So the first few years, you lose 6%. But when you will not make extra 4%, right? The Fund B gives you more return. But this one gives you less risk. So overall, you still make 2% on average. But take a look at your equity total capital return. $11,819. You'll be a few $100 better off than Fund B. So which one is more important? Looking for higher rate of return, or looking for instrument that allows you to reduce your risk, reduce the chances that you will lose money? Okay, that's the reason why, right? There's a saying. Some of you probably are very, very seasoned in this investment area. If you're able to take care of your losses, that means if you know how not to lose, the winnings will take care of itself. So that is the reason why you do not let greed allow you to let greed be your myopia. That means blur your vision in terms of your total return. So bigger percentage of return doesn't necessarily mean that you will end up with more money in the end. So this is what I wanted to share with you in terms of the mistakes that many investors are making. So a lot of investors, they're always looking for big return and they don't really care about the losses. So if you're looking at that, and over the long run, after a few years, after a long period of time investing, when you look back, you'll be realizing that how come when I make so much, but I don't seem to have a lot of value? Because the market is very volatile. Yeah. So when you win big, there's a chance that you will also lose big. So because of that, right, how do you organize a portfolio and own those shares, right, whereby you do not just look at the total capital return, the rate of return. You should also look at the volatility level, right, of the instrument that you're looking at. Because, right, if let's say you're looking at something, although they may have very big return, but when they plunge, they also plunge in big number, and thereby you have a lot more risk. And because of that, right, because of this reason, I always prefer stocks that allow me to have more dividend. So yes, overall stocks will be up in the long run, but imagine during those downtime, right? During those downtime, is that stocks will continue to give me return. So for example, there are stocks like REITs, or there's one new one, right? Okay, there's one new one that is only recently incorporated. I think so, okay. It is called the SPYD. SPY will be the index fund with high dividend stocks. So they combine. So these stocks will give you about, I think, 4+%. I think because of this crash, probably the return will be slightly higher. You can take a look. And when the market goes up, it will continue to go up. Can you see? When the market go up, this will go up. But when the market come down, they will also come down. However, you still continue to get the rate of return. So as a result, whatever that is going down, because of the dividend, right, it will help you to cushion and hedge against your losses. And overall, when it bounce back up, yeah, so in the long run, you probably will make a lot more. And this is just an opinion, okay? an idea that you can explore further. So remember, if you decided to buy, please do your homework. And also, if you like whatever I've been sharing with you, please remember to click on the subscribe button. So I'll be sharing a lot more this kind of a video. And whenever I share this kind of update, I hope that you will be able to get all this information and get yourself up to date so that you will be one of those, right, who is gonna not go hungry because you are not foolish. Okay? So if you like whatever I'm saying, remember to click like. And if you have any questions, please leave your questions on the comment box and I will try and get back to you as soon as I can on all the comments that you guys have. All right? See ya.